Imagine this, you're about to buy your dream home or that car you've always wanted. You've saved up for years, you're all excited, and now the bank rejects your loan application because of something called a credit score. Well, if your loan is rejected due to a bad credit score, you're not alone. Today I'm going to tell you why your credit score is like your financial Aadhaar card and how it can make or break your biggest life goals. Trust me, after watching this video, you'll never look at your finances the same way again. So what exactly is a credit score and how it's calculated? Your credit score is like your financial report card. It's a 3-digit number that tells banks and lenders how trustworthy you are with your money. The higher your score, the more likely you are to get approved for loans, credit cards, and even home loans. So let's break it down and understand what goes into your credit score and how you can improve it. First things first, what exactly is a credit score? It's a number between 300 and 900 that represents your credit worthiness. It's like a grade that you get based on your credit history. If you've been responsible with your money, paying your bills on time and not borrowing too much, you'll have a higher score. But if you missed payments or maxed out your credit cards, your score might be on the lower side. So who calculates your credit score? In India, there are 4 main credit bureaus: CIBIL, Experian, Equifax, and CRIF Highmark. These agencies collect information about your credit history from banks and lenders and use it to create your credit report and score. And if you're new here, I'm Pradeep Mocherla, based in Ireland. I'm working as a senior product manager with over 10 years of experience in the corporate world. I've worked with companies like Google, Amazon, Apple, IBM, MasterCard, and some innovative startups too. I make videos on careers and finance topics, and if these interest you, please subscribe to my channel. Now let's talk about the 5 main factors that affect your credit score. Number 1, payment history. Your payment history is the most crucial factor in determining your credit score, accounting for 35% of your CIBIL score. It reflects your ability to repay debts on time, including credit card bills, loan EMIs, and even utility bills. Late payments, missed payments, and defaulted accounts can significantly damage your credit score, with more recent and frequent late payments having a greater negative impact. To maintain a good credit score, it's essential to establish a habit of paying all your bills on time. Set up automatic payments or reminders to ensure you never miss a due date. If you're facing financial difficulties, contact your lenders proactively to discuss potential solutions such as restructuring your debt or seeking a temporary payment deferral. Number 2, credit utilization. Credit utilization, which makes up 30% of your credit score, is the percentage of your available credit that you're currently using. A high credit utilization ratio, above 30%, suggests that you're relying heavily on credit and may be at risk of overextending yourself financially. This can lower your credit score. To maintain a good credit score, aim to keep your credit utilization below 30% on each individual credit card and across all your cards combined as well. For example, if your credit card limit is 50,000, try to keep your outstanding balance below 15,000 rupees. If you have high balance on your credit cards, consider paying it down or requesting a credit limit increase to lower your utilization ratio. Number 3, credit history length. The length of your credit history accounts for 15% of your credit score, and this factor considers the age of your oldest credit account, the average age of all your accounts, and how long it's been since you've used your credit accounts. A longer credit history demonstrates to lenders that you have experience managing credit responsibly over time. Avoid closing old credit card accounts even if you rarely use them, as this can shorten your average credit history length. If you're new to credit, consider becoming an authorized user on a family member's or friend's long-standing credit card account to benefit from their history. However, make sure the primary account holder has a good credit track record, as their behavior will also impact your credit score. Number 4, credit mix. Your credit mix, which accounts for 10% of your credit score, refers to various types of credit you have, such as credit cards, personal loans, home loans, and even car loans. Having a diverse mix of credit types shows lenders that you can handle different types of debt responsibly. While having a mix of credit is beneficial, avoid taking on unnecessary debt just to improve your credit score. If you only have credit cards, consider taking out a small personal loan or secured loan and paying it off responsibly to diversify your credit mix. However, maintain a balanced approach to your credit mix and only take on debt that you can comfortably manage and repay. And number 5, new credit inquiries. New credit inquiries account for 10% of your credit score, and each time you apply for a credit, a hard inquiry is made on your credit report, which can slightly lower your score. So credit inquiries come in 2 forms: soft and hard inquiries. Soft inquiries, like checking your own credit, doesn't affect your score. Hard inquiries, which happen when you apply for credit or loan, can slightly lower your score, and too many hard inquiries in a short period may make lenders concerned. To minimize the impact on your credit score, be strategic about applying for new credit and only do so when absolutely necessary. If you're shopping for a specific type of loan, such as a home loan or car loan, multiple inquiries within a short time frame, usually between 14 to 45 days, may be treated as a single inquiry, minimizing the impact on your score. Regularly monitor your credit report for unauthorized inquiries, as these can be a sign of identity theft or fraud. If you spot any suspicious activity, contact the relevant credit bureau and lender immediately to report the issue and take necessary actions to protect your credit. Keep in mind that while these percentages and factors are generally applicable, the exact algorithms used by Indian credit bureaus may vary slightly. However, the principles we've discussed are universally important for maintaining a good credit score. So now that you know what goes into your credit score, let's talk about how you can improve it. Number one, pay your bills on time every time. Set up reminders or autopay to make sure you never miss a due date. Number two, keep your credit utilization low. Try to pay off your credit card balances in full each month, or at least keep your balances below 30% of your credit limit. Number three, don't close old credit accounts even if you're not using them much. Keeping them open can help your credit history length. Number four, be selective about applying for new credit. Too many hard inquiries can hurt your score, so only apply for credit when you really need it. Number five, check your credit report regularly for errors. If you find any mistakes, dispute them with the credit bureau to get them corrected. Remember, building a good credit score takes time and consistency. But by following these tips and being responsible with your money, you can unlock better financial opportunities when you're really in need. I hope this information has helped you understand the importance of your credit score and how to improve it. If you have any questions or want to share your own credit score success stories, leave a comment below. See you in the next one.